Well, greetings everybody, and welcome to the May session of the Roundtable. I'm joining you in the middle of an electrical storm that is apparently causing some tribulation, so hopefully I'll be around for a while now. Can you hear me okay now, Ken?
We can hear you just fine. Mark, you are on a different resolution, so we're seeing just a reduced size of your screen right now.
Okay, why don't I go ahead and fix that before we get started? A little better?
Yeah, it looks good, Mark.
Okay, let's go ahead and we'll get started now. We're actually only a couple minutes late, and I've been doing some serious gymnastics for the last 30 minutes trying to get here. Well, welcome everybody. I'm joined here by my friends Ken Kavula, Cy Lynch, and Hugh McManus, and welcome to the May session of the Roundtable. Tonight we'll be featuring four companies again, a couple of repeats and a couple of newer companies. I don't know, did you guys get a chance to talk at all about your New York Times appearance, Mr. Kavula?
We didn't do much talking, Mark. We were doing some scrambling of our own here, so.
Well,
we were worried, Mark.
You were worried?
Deeply concerned for you. Yeah, we had all kinds of fears that you might have been zapped up by the lightning storm.
Yeah, I think I was abducted by aliens or something. But the picture of Ken there on the left is from the New York Times article this weekend where Ken talked about the virtues of long-term investing. So, nice job, Mr. Kavula.
Well, thank you. I appreciate that. I've heard from people that I haven't heard from in 30 and 40 years. That paper evidently gets pretty good distribution, doesn't it?
I don't know if Roy's in the audience, but Roy was also featured in the article.
Yeah.
Roy Chastain from Sacramento. Well, let's go ahead and get underway. Here's our standing agenda. Welcome to anybody that's returning, and if you're a relative newcomer here, we follow this basic standing agenda every month for the last basically 5 years. Again, welcome to everybody. We will go over the results of some of our selections over the years. We do have a couple stocks on the hot seat tonight, and then we'll break into a series of presentations on the four companies that are shown. And we almost always have an audience poll at the end of the evening where you're allowed to select from the four that are presented, and we usually have a fifth, none of the above choice also. Let's get the disclaimer out of the way. This is all about education and demonstration. It's for illustration of a concept, of a philosophy, and a process for discovering and owning, for as long as it makes sense to do so, stocks as investments. And if you want to be added or you have a friend that wants to be added to the reminder list, again, we do this towards the end of every calendar month. You can use the address at the bottom there, nkavula1@comcast.net. If you have any questions, feel free to fire them off to me, Mark R. at manifestinvesting.com. Just a quick reminder, we're going to share, what one of our favorite investment opportunities. The four of us will do that. We do keep track of what we do. We do tolerate and encourage some speculation from time to time. I think Hugh's going to fit into that basket tonight. And we are attempting to outperform the Wilshire 5000 by 5 percentage points. That's 500 basis points over the long term. And we really would like to see roughly 60% of all selections outperform the Wilshire 5000 over the time of the holding period. Here's a quick look at our results. You can see they're continuing to improve. The trend is in the right direction. We aren't quite at the 60% outperformance accuracy, but we are at 50. Again, relative return, just to define it, is our actual rate of return minus the rate of return if that had been invested in a Wilshire 5000 index fund. And we're basically beating it right now as we come up on that 5-year mark by 2 percentage points. So the red dotted line is the objective. We'd like to get up to that. We'd love to live in that green area between 5 to 10% if we can. We'll be thrilled if we stay positive. We'll be thrilled even more if we get above 5% and stay there. But again, the trends are in the right direction, and there actually been some pretty solid results over the last several months. Here's a quick look at the tracking dashboard, the tracking portfolio for the selections that we've made over the last 5 years. Here's The link at the top is a public link. You do not have to be a Manifest Investing subscriber. You can just type in that URL and it will take you to the dashboard. We try to keep that fairly up to date. And what you see ranked from top to bottom are the most influential and the most commonly selected companies. Again, in the time that we've been doing the roundtable, Cognizant, for example, has been selected 11 times. What we do is take and invest $1,000 every time a selection decision is made. So $11,000 invested into Cognizant is now worth $18,746. It represents approximately 6% of total assets at this point. And just going down the page, you can see the companies that have been among the favorites amongst the four of us. And every once in a while, we have a guest damsel or a guest knight that also will make a selection. And keep in mind, we do also add $1,000 and tag selections as audience selections as we go. Any comments or questions at this point, Ken?
No, things are looking pretty good right now, Mark. If you want the legend as to how many times something's been chosen, if you call up the original dashboard, and it's listed on the right-hand side of the home page on Manifest, or you can use the URL, as Mark said. At the top of that dashboard, you'll have a legend as to how many times each company has been chosen, and of course, if a company's not listed up there, then it's only been chosen once.
Right, and in fact, we're going to go, as we go through our hot seat challenges tonight, you'll see what we mean by multiple selections. A couple of them are selected a few times. Staples, for example, is a 7-time selection, all by Hugh. But $7,000 invested into Staples is now worth nearly $10,000, and you'll actually get a look at the anatomy, kind of a forensic look at what has gone on with Staples for the last few years. So we'll take a closer look at that, and it'll become a little bit more clear, how that all adds up and fits together, stock by stock. We generally stop and take a look at the portfolio report card, and I thought we might invite Cy if Cy has any comments about tonight, if you're comfortable with that, Cy. What do you see? How would you think of this
on
the
portfolio report card?
Yep.
All right, sure. I would be glad to talk about it. I will sound very much like Mr. Kovula in that I look at this card very similar to the way he does. The first place that I go is I look at the total return potential, the par, and you can see that it's 10.7, which is not green, and I glance up at the sweet spot and see that our minimum goal would be 11.8 for the par. So that tells me right offhand that we may be looking at challenging some stocks so that we can bring the par up hopefully over the 11.8%. Realize in your own portfolios, in your club portfolios, depending on how far that gap is, you can sometimes bring it up simply by investing some new money. But I can tell you with the size of our portfolio, and even $5,000 invested in a single stock tonight wouldn't do that. So we're going to have to do some challenges, and that's why Mark mentioned that. Then I just move on down. I take a look at the quality. Notice it's excellent, so we don't need to address quality. The third thing that I personally check is the next to the bottom line, which is financial strength, which is 80. Again, I like to see that at a minimum of 70 to 80, depending on the market conditions. Right now, the market's relatively high by historical standards, or stated differently, my par is relatively low by historical standards, so I prefer to see that closer to 80 right now. And again, you can see that it's at 80, so that's just fine. And then the fourth thing that I check is the growth item, which again, we like to see in the 10 to 12% range, and right now it's a little below the 10. So again, keeping in mind our challenge that we'll be doing this evening for the par, we also may want to make sure that we try and boost that growth number a little bit higher. You can see earnings stability, PE ratio, and yields there as well if you happen to take a look at any of those. I don't have any particular criteria for them. That's just information only. So by and large, our portfolio's in good quality shape, but we could use a little bit more return and growth. And I think that will give us a lead into our challenges.
Okay, any other thoughts from either Ken or Hugh?
Ditto.
Well, that's pretty good vote. In that case, we'll go to the bat cave or the sandbox. What I've done here is using the worksheet function at Manifest that you can use for any portfolio or dashboard to basically export a worksheet area, which we do refer to as the sandbox. And in this case, what I've done is taken and sorted the entire portfolio by the return forecast, the projected annual return, so that I could isolate the 3 lowest ones. That's what you see over there on the right. So these are the ones we kind of threw on the hot seat a month ago. There may have been another one, but these are the 3 that are on the hot seat right now. And we can basically talk through these. And I wanted to use, they actually give us a pretty good demonstration of, how the positions are kept. We'll start with the first one there at the top. Cash America was a Ken selection, and it was made back in September 2012. You see that from the average purchase date. And at an average cost of $16.63, which you see there, it's actually now gone to $26.63. That's roughly a 60% gain in total return on an annualized basis. Again, this is about a 3-year-old, it's actually 2.7, almost 3-year-old decision. Ken's decision has gained 19%, 19.3% annualized during a period when the market has gained 16.2% annualized. So again, this is that relative return thing we talk about. The 19.3 minus the 16.2 gives you a 3.2, pretty good situation. Ken, do you have any thoughts on how this has gone or how the company stands today with respect to the situation?
Yeah, I still follow a number of these companies in the credit services industry, and I still think there's some opportunity there, but I'm more than happy to let go of this particular one. Its sales, if you notice, has slowed now to about 4% anticipated. It's actually negative. So let's keep the positive relative and not worry too much about looking back.
Okay,
I think it's a good example also, Mark, of when the market's giving you 20% or something along those lines, or when the market's giving you 16%, why it's a great idea to aim at the market or above the market, and not dwell or not keep focusing on a single fixed value for return. Focusing on 15% when the market's doing really well doesn't serve you very well and makes you feel real bad when the market's doing poorly if you're trying to do 15 when the market's only doing 4 or 5.
Mm-hmm. So I guess unless there's any objection from Cy or Hugh, I would second the suggestion to jettison Cash America and do a high five and basically boost the overall growth and the return forecast of the portfolio a tiny bit.
The only comment that I make is just kind of by way of general explanation, the way that I would approach it as a member of the round table, and I think basically we all do. I look at the number that Ken just pointed out, the 4.2 growth and the negative par, and I do not follow Cash America. So just based on those 2 numbers, for me, it is a challengeable stock, and we should sell it, particularly since we've got a positive return. My only qualification would be if someone following it closer either has some problems with those consensus numbers or it's a special situation of some sort. And I didn't hear Ken say either of those things, so I would concur. Let's sell it.
Yeah, the only regret that I have, Mark and Cy, is that with this kind of artificial creation of this portfolio, and with some of us attempting to bring a number of different names just for interest sake to the roundtable. I only regret that I didn't pick it, three or four or five times in a row when it was a good screaming buy. That's all.
Yeah, we've seen people do that.
Yeah.
Okay, so unless Hugh has any objection, we'll go ahead and jettison that one. And that's a good segue to Hugh. Hugh has made the selection of Staples several times, and he can explain his thesis and if he still believes it's intact today. As you can see, roughly half of his positions have done very well, and the others have languished a little bit. What do you see in the road ahead for Staples, Hugh?
Well, it's. I hope you can hear me all right. Staples will still struggle in the short term as it tries to find the best business model for what it's doing in a changing landscape. The huge advantage Staples has is that it is the #2 online retailer in the U.S., and that's important because it is up against many other very strong companies, Amazon being an example, and perhaps Walmart, that have moved into this area. I think it has too much real estate, but that problem it is solving slowly. When you actually look at the company, its revenues aren't performing that well, but it is moving into a turnaround situation. I think there's, and by the way, you can see also that it is experimenting like crazy. Anytime you go to Staples, there seems to be a new thing in the aisle. Now, it's been doing candy and coffee for a while, but there's all kinds of new things that it has been selling in aisles for a while. It's been moving into phones pretty heavily recently, too. Now, I know it's had a positive return, but this is a company that I would continue to hold on to. I own it myself in my portfolio. It pays not a bad dividend. And I would hold on to it. One of the challenges, I think, with the way that we look at a portfolio like this, as Ken and I were discussing earlier, my outlook is 30 to 40 years. So I can see things change gradually over time, and I'm much more patient, I think, than some others, maybe not many others, but at least some others, for a change in the fortunes of a company like Staples. It's doing the right things. It's reducing its footprint. It's expanding where it needs to go online. It's up against, as I said, it's in a tough market. The two other companies in that space are merging. And we'll see a real fight then as to who the leader in this space should be. I still think it will be Staples. But I'm keen to hold on to it, at least for a little while longer. So
you expect that it still could be a private equity takeout, or?
I think that's going to happen. I don't see how it can't happen, actually.
Well, it is a fascinating study because some of the majors like Goldman Sachs and some of the others have a pretty strong outlook on the company that does not match the analyst consensus at all.
No. And that's the other point, too, that the analyst consensus, very often, in my opinion at least, I would call it short-term the way they look at things. It's just the industry they're in. They have to look short-term.
Mm-hmm.
Up to three, even 5 years in some cases, and that would be almost long-term for them, 5 years. And that kills a lot of the companies that I look to, because I want to find, the healthy animals that are limping on the side of the road. You just take them in, bandage them up a bit, let they spray and recover, and they're off and running again. As long as the basic thesis behind a company, and granted, Staples has been wounded a little bit, but as long as the basic thesis is intact, how it generates sales and how it generates earnings.
Mm-hmm. Well,
I would hold on. And the same thing for Deere, by the way. I think Deere and Caterpillar both have a very strong long-term future.
Yeah,
but right now, they're in the doldrums because of the markets that they're in, and they will be in the doldrums for a while.
Yeah, and I think the analysts have really suppressed or really deteriorated their expectations. Maybe they're kind of in the trough a little bit.
Mm-hmm.
And that obviously affects the par.
Companies that when the analysts start doing that, they dictate long-term solutions for short-term problems. So they restructure companies grossly, whereas very often I think they need to hold on for a while and let the storm pass. And in this case for Deere, and more so for Caterpillar, this storm is short-term. I mean, they went to the trough and gobbled up a lot, been very successful business in China. Well, that has dissipated to some extent and may not reappear in the short term, the next 2 to 3 years. So they have to just go back to their knitting and do what they've been doing in the past, and they will recover, and the stock price will bounce back as a result.
Any other comments, guys?
Mark, I'm willing to defer to Hugh's judgment on both of these. This is a game, and it's a long-term game, and let's see what happens. We can afford to give Hugh another year.
My only question, and hopefully this isn't showing extreme ignorance, I thought that Office Depot had already purchased Office Max, and they were operating. Well, they are corporately one company operating under two brand names, and that Staples had a buy offer, or actually a contract subject to review with Office Depot to make there be one total.
That's right.
Okay. I was just hearing talk about Office Max and Office Depot, and I thought that was a done deal, and then
yeah, it's a done deal, and they're not fighting again. I mean,
Office Depot.
Yeah. And by the way, a number of years ago, it must have been 15 years ago, when a merger between either Office Max and Office Depot and Staples was suggested, either Justice, one of the components of government, vetoed the thing directly because, it was anti-competitive. But as I pointed out, this landscape has changed. A lot of these purchases, particularly in big business, now is done online. Even 15 years ago when I was at a startup, we bought most of our office materials from Staples, but we bought it online. And that business was just starting then.
Well, I guess what I would propose maybe for next month or a couple months down the road is to take a closer look at some of the divergent opinions on Staples, because there's some out there that support what he was thinking rather dramatically, and it might be interesting to kind of do a point counterpoint with some of that type of information. So we'll leave it tonight at jettisoning our only negative return forecast in the portfolio. Cash America, do a high five and celebrate with Ken a little bit, and we'll just move on. So with that, Ken has selected Gentex, a wonderful Michigan company, to bring to the group tonight. Ken did select it a year ago, as the audience also selected it May 2014. So it's time for our annual checkup on Gentex. Take it away, Ken.
Well, in May 2014, we were live at the convention, Mark, with
Is that right?
You and Hugh. And if you remember, we asked people to raise their hands and make the pick for which company they were going to move into.
Oh, I remember.
Yeah, I know you do. I wasn't going to remind you about the results, but Gentex did win the audience poll, and let's look at it again real seriously. If you could slip the slide for me here. Here's a brief history of the company. It's been around for about 35 years now, since the early 80s. It went public in 1987, and its first products were mirrors. Many of the cars that are being driven today by folks in our audience have Gentex mirrors in them. They automatic dimming types of mirrors, mirrors that do various things, and you can follow the timeline and notice that the technology on the mirrors kept growing, and eventually Gentex added a few other products to its stable. It added the product Smart Beam back in the mid-2000s and has upgraded Smart Beam in 2012. Essentially, this is a system that automatically dims your headlights. It takes control of the high beam away from the driver. They find by doing traffic studies that most drivers don't use the high beams very effectively. And so Smart Beam takes control of the high beams away. On top of that, Smart Beam also controls your headlights so that they actually turn the headlights into a curve, and they automatically deal with ways that roads go up and down, keeping the lights aimed at the road rather than into the air. We also began in the around 2010 to bring the dimmable programs and the dimmable products to other vehicles besides cars. You'll notice up there at the beginning of 2010, dimmable windows went into aircraft from Gentex. In 2000, say give it 2012, 2013, Gentex acquired HomeLink. It's a system that allows you to open the garage door if you have an automatic garage door opener without using the openers supplied by the garage door company, but rather links it right to your car's electronic system. Well, that HomeLink system is being expanded now so that it can open all kinds of different things. It can open the doors of your house. It can open a security gate, or it can open many other types of things, and it's being tied into all types of security systems and all types of products that are part of this whole philosophy called the Internet of Things. You'll notice that in 2014, Gentex began selling full display mirrors. Basically, these are mirrors that contain cameras so that when they're not being used as mirrors, they're displaying all types of information from cameras, from LEDs, from all types of input that could eventually come from your phone, your tablet, a computer in your home, come from many different things, and make the mirror one of the primary communication centers of your cars. So Gentex has done a lot of research and development to keep itself current. If you flip the page again, Mark. Dimming applications have grown from 2001, interior and exterior applications from 9 and 4% in 2001 to 25 and 7% in 2014 of all of the autos that are being produced in the world, and that still leaves an awful lot of autos to penetrate with these automatic dimming types of mirrors. So Gentex has a huge potential customer base and only a couple of competitors in the field at the moment that it deals with in these types of high-tech mirrors. Another flip again, Mark. And now we're just looking at growth drivers, and I love to see when the companies tell me what's going to drive their growth, and I'm going to go through these zip. The growth driver is frameless mirrors, brand new stylish mirrors with absolutely no frame, more space for information. Click again, Mark. Here we go, all kinds of outside mirrors that include mirrors with curved glass and include mirrors that not only deal with what you see, but what will see you. So it'll warn you when different cars and trucks are approaching in your blind spot, and it'll also be the place where you'll be able to see if your turn signal is being activated. This type of high-tech mirror is driving the growth in the company. Click again, Mark. The HomeLink system, which I explained already, turning on your lights at home, opening your doors, turning on or off the stove or the refrigerator or some other major appliance, opening security gates. Click again, Mark. The smart beam, where your headlights will dim automatically, or they will go to high beam automatically, and where your beams will stay on the road instead of moving off into a field as you make a turn or up into the sky as you come to the crest of a hill. Click again. Also, brand new markets, moving these mirrors into motorcycles and all-terrain vehicles and construction equipment and airplanes and anything that moves on the ground that could use a mirror, that could use a sensing system, from something as small as a lawn tractor to something as big as a giant earth mover, creating brand new roads or doing mining work. Click again. And then these full display mirrors, where not only will you get the actual view of what's happening behind you, but the mirror will be used for all kinds of communication, and it'll become the center of the the technology in the car, eliminating that big separate screen that a lot of cars are experimenting with right now. Click again, Mark. Again, I love the lines the last 4 or 5 years. It is a cyclical company, obviously, but the last 4 or 5 years, the growth has been pretty consistent. For an auto supplier, this is unusually stable growth going on. You can see that I've estimated growth going forward at about 13%. Earnings growth, Value Line's estimates about 12%. So I think that, one more click, Mark. The conclusions that we're going to draw are all going to be relatively the same. Here's my SSG. I've decided that PEs should stay somewhere in the 12 to 20 range. That's an average PE of around 16 somewhere. One more click, Mark. And that gives me a projection value of 13%. Value Line says low total appreciation around 12%. And here's Manifest's Eagle. One more click, Mark. And that's coming out at 11.5%. So all three of those numbers are nicely clustered together. It gives me a lot of confidence in the research that I did, and a lot of hope that I'm going to be in the right ballpark when it's all said and done, and I'll take a good solid 11%, 12%, 13% growth rate anytime you want to give it to me. The numbers are slightly different in each one of the analysis, but the results are pretty much the same. So let's add another couple shares of Gentex to the portfolio.
Thanks, Ken. Yeah, and this is an example. We'll have a company leaving the portfolio with a low single-digit growth rate, replacing it with 10% growth rate. So we'll make a little progress in that direction, as Cy said we needed to do. All right, let's go ahead and turn Hugh loose on a company I've never heard of before.
Yes, and apologize in advance for what it may or may not do to the growth rate, given the fact that this is an emerging company. And I haven't done this before to this portfolio, although in discussions with Mark about various different emerging biotech companies over the years, or the last particularly 4 years that we've been doing this, I have given him some examples that have performed very well, and he had commented once or twice that pity he didn't put that into the portfolio at the time. But now I've decided I would take a bit of a swing for the fences with this company, Ardelyx. And I was prompted to do this because the National Convention 2 weeks ago was held in Silicon Valley. It was held in not Sunnyvale, but San Jose. And not a few miles from San Jose is the city of Fremont, where Ardelyx is headquartered. And we had our usual Thursday night event, chatting about stocks. And I thought, why not pick a local one? And the more I thought about this one, the more I liked it. But again, there's a lot of risk here. But let's move to the next slide, and I'll give you a little bit of background. And I tend to put about 3 to 5%. Now, I used to put a lot less. Today I put a little bit more of the material, the monies that I invest into extremely high risk. That is non-better investing or non-NAIC type companies. And I do this with the intent of getting an above average return. Certainly it doesn't always happen, but when it does, it gives me the funds to go and buy the regular, what I might call the boring old companies that we all actually know and love, and that will be with us for the long term and will look after us when we get a little bit older. Many of these fly-by-night companies simply won't be there, but in the short term, they sometimes do marvelous things, and particularly the companies I try to single out are companies that likely will be there for the long term. And this really was started, at least the reason I started doing this, was a comment that Peter Lynch has often made in his books about investing in what you know. And certainly we can do that, but in my industry, there are a lot of companies that you get to know very well. You get to know how they operate, how they work, what are the likely success factors. But the fact of the matter is that for most of the life cycle of these companies, they are not NAIC type companies. And by the time they get acquired, and very often the stock has gone up 50 or 100 times, it's too late to invest in them. And the company that you end up buying, if you want to follow the acquired company and any longer, is the stodgy old pharmaceutical company that we all know and love. And so I took the gamble years ago to put maybe 2 to 3% of what I invest at risk. And I certainly would understand the risk, but I wanted to learn how a prototype of an NEIC company would come into existence. What are the things to look for? What are the things that you try to have to predict? Because many of these, the companies we invest in, are small, know-nothing companies when they start. And it's when most of actually the growth of that company has come to a stop, and at least most of the dramatic growth has come to a stop, that we start to invest. Microsoft would have been a good example of that. But there are many others that would have jumped up maybe 50 times, and granted they're going to double, triple, quadruple many times over the following 20 years, but it will be a much slower growth, but a much safer one, let's be honest, than what had happened in the past. And the advantage for me to try to spot the elements of success for a long-term company is that it put my mind in the direction of what is going to be an NEIC company in 5 to 10 years. Can I predict that? And the big thing that it gave me was it made me much stronger as an investor. But interestingly, because I would focus on biotech companies, the area where I work, it professionally made me a much better person at my job in identifying these companies and bringing to the companies that I work for opportunities that I think will be with them for the long term. So it not only made me a better investor, but it made me a better professional in my industry. And that's one of the reasons I've often suggested to people is to look around at what you're doing, look at those very nascent early companies. You probably have a better understanding of what it takes to make these companies tick than many of the professionals in the field. And most of us seem to know that, but we do have this instinct to steer away from risk, and that's a good instinct. But as I often say, risk has a powerful neutralizing force called time. And if you can combine the two of them correctly, you can get above average returns. Now let's move on and talk about Ardelyx. It's a company that is on the NASDAQ. It is an early stage biotech company founded just over 8 years ago. And it is a small molecule company. And by small molecule, I'm talking about not proteins or antibodies or peptides, which can be quite large. They're bulky, hefty molecules. A small molecule is something like aspirin, the active ingredient in Lipitor. These are molecules that when you digest them into the body, they go everywhere in the body, but you hope the concentration at the point of pain or the point where they need to work is high enough that these molecules can get active. Ardelyx has taken a different approach to this and has targeted things in the gastrointestinal tract, your gut, your stomach, that whole area, small, large intestine, before it actually gets into the bloodstream and goes to other parts of the body. And it looks for diseases that it can cure there. So it is called a non-systemic approach, and that's novel. And it's looking for cardiorental. That should be cardio-renal, spelling mistake there. Things to do with the kidney and the heart. So really to try to solve problems before they get bad, or various cardiovascular or metabolic type diseases. And the lead drug at the moment is a drug called tenapanol. And that's recently concluded a phase 2B clinical trial. So let's move to the next slide. And I'll just briefly talk about, and I mean briefly, clinical trials. But you can see here, this is the pipeline taken directly from the website of this company, which is www.ardelyx.com. It has one drug that's currently closing into phase 2B for 3 indications. One is for irritable bowel syndrome, which is the second one there. The other one is for end-stage renal disease, which is a very big market. And the third one, which is a chronic kidney disease, released results recently, and they weren't that promising. And there are other drugs in the pipeline as well. One is partnered with Sanofi, and the others it's bringing to the fore by itself, but they're preclinical, so we don't really know much about them. But the one to focus on is tenapanol, which is the very first one. Now, we skip to the next slide. This is just a really quick and dirty look at the process to bring a drug to market. You have to go through clinical trials. And you go through clinical trials generally in 3 phases. Phase 1, where you're really focused more or less on safety. Phase 2, where you're looking at dosing. How much drug do we put into a patient? And what's the least amount of drug that we can put in there and still have it to be effective? And then phase 2B is like a highly controlled phase 3 clinical trial. A phase 2B trial is to really look to see if the drug works, to look at efficacy. We're always looking at safety, but the emphasis here is on efficacy. And you're really looking at a very controlled patient population, monitoring them extremely carefully. And if it's successful, very often in the industry, they say, we have a drug. But then it has to go into phase 3, where you're looking at hundreds of thousands of people, and you're trying to mimic the overall patient population that would be in the market for this drug if it proves to be successful. By and large, if you've got a phase 2B trial, proof of concept it's called, that is successful, it's an extremely good sign. The phase 3 results are never better than a phase 2B, but if you design your trial correctly, they will mirror what you saw in the earlier trial. And if we skip to the next slide, by the way, I'm going to upload to the Manifest site a number of resources that you can look at to look at clinical trials, look at success rates, look at how companies bring drugs to market, etc. These are public domain documents. They're very well written in many instances and can be very informative. But if you look at the chart from left to right, this shows the probability of going from phase 1 to 2, phase 2 to 3, and phase 3 to what's called NDA, which is a new drug application, asking the FDA, can we market this thing, or a biologics licensing application if it's a large molecule. And you can see that the rate of going from phase 2 to phase 3 is low in general for a phase 2 drug. It's about a third. But the fact that this is a phase 2B molecule kind of doubles it and brings it closer to 50 to 60%. Plus, there are 2 indications. So this is a very, very positive sign for this company. It doesn't guarantee anything, but it is a positive sign, and particularly when you dig into the clinical trial and look how it performed and look at its toxicity or its side effect profile, it seems to be a very, very strong candidate for a drug that will, in about 3 to 5 years, get approved. So if we move on to the next slide, you can see that recently the company hit a low. And it hit a low because of this problem that it had with chronic kidney disease, the third indication it was going after. Now, that's a very crowded space. So even had it been successful there, and there's no guarantee that they will not come back, redesign their phase 2B and move forward, who knows what they'll do. But the fact of the matter is it is a crowded space, so they would be getting a small piece of a large pie. Whereas what they've got in irritable bowel syndrome and the end-stage kidney disease is quite a nice market, and by and large, it doesn't have as many competitors there. And since I presented this company at the National Convention, it has been very bad and has gone up $2 from 9 to 11. It has a lot of cash, 100 million, and it is approaching a decision point with its partner, AstraZeneca. At the end of next month, AstraZeneca has to decide whether it wants to fund the phase 3 trials. It has been paying for all of the trials to date, and it has to decide whether it wants to fund them and go forward. Now, I hope it doesn't, and I hope it doesn't because if AstraZeneca makes that announcement, the stock price will drop, but the company has enough money on its own to carry out a phase 3 trial and bring a drug to market. And so I think that as an investor, it will be a very unpleasant event, but long term I will do better if it doesn't have this AstraZeneca partner, but it'll end up with another one, no doubt. However, if AstraZeneca does take the uncertainty out of the air on the 29th and announces that it's going to fork over whatever amounts of money that it has to do, between 50 and 100 million to run the phase 3 clinical trial, that's a good sign for the company as well for the long term, and I imagine that it will have a nice impact on the stock as well. So I don't really understand why the stock price, and it hasn't been public for very long, less than a year, why it has gone as low as it has to $9. It didn't make a lot of sense to me and still doesn't. But there is uncertainty in the air, and that uncertainty will be resolved in less than a month. And so if we move on, I think we reached the last slide, and I know I'm talking a little bit at the moment, but I'm really reiterating in this slide what I've said in the past, and I should have moved this slide forward. That approval is never certain, but a phase 2B trial with what's called a low p-value, and for those of you that are statistics nerds, basically all that it means is that the result that you've got can't be attributed to chance. So if it's 0.001, which the p-value for this trial was, the trial I'm talking about was 0.001, it means it's about 1 in 1,000 that the result you got was by chance. And when that's coupled with a very nice side effect profile, it's a good sign for a potential drug. But the drug has to go through 2 phase 3 trials that will involve hundreds and perhaps 1,000 or more patients. And they are independent trials, and each has to be successful if the FDA is to grant approval, marketing approval, so the drug can be sold. So that takes time, and we're a long ways off before the company can generate genuine revenues by selling product rather than doing licensing deals. And that's why this is a high-risk company. But these are the kinds of companies that I've come to know and love and benefited from greatly. And we skip on to the next slide. It should be it's AstraZeneca again. And I talked about this, the partnership. They make a decision at the end of June as to whether they stay or whether they go. Line from the famous song. And we move on one more time. Ardelyx is high risk. I have added it to the portfolio and probably continue to do that. Others shouldn't. And I don't know if we warned people at the start, but everything we say here, by the way, is just for illustrative purposes. And I really get very worried when I talk about these companies. I hope people don't run out and buy them. That's a huge mistake. But I do think people should look at emerging companies so they can understand the industry they're in a little bit better. I believe this company does have a drug, and if managed successfully, it should be successful in phase 3, but there's a significant amount of risk there. If AZ funds the company or refuses to fund the company, the price will fall. If it funds the company, heck, I would expect the price to fall. And good news, too, with these companies. You never know. But if it does fall, I'll buy more. And if it rises, but not too much, I might still buy more. But for the long term, I think this company has a happy future. So that is my extremely highly risky company for this evening.
Well, very cool. Well, thanks, Hugh. They're certainly working in some very key areas, and sounds like they're having some pretty good success. So it'll be kind of fun to see how this one plays out. And again, we're not talking about a huge part of the overall tracking portfolio, so maybe we'll have some fun. Those of you that are familiar with our Groundhog contest know that Hugh basically wrecked the field a year ago with picking one of these and successfully delivering on a Grand Slam.
Yeah, Intermune. And it was very clear that it should work, and I was shocked that so many analysts didn't jump all over this company.
Well, this one will be kind of fun to watch. All right, let's go ahead and move ahead to a completely different area. Michael Kors, in an area that I really don't know that much about, fashion. But in this case, those of you that are familiar with the company, it's been around for a few years now. It could be called a competitor to companies like Coach. What you see here is the type of ad that they have, fresh electric hue. Some pretty good products. They do sell to women and men, which I find kind of fascinating. They've tried to sell to the guys from the get-go. So what Coach is now trying to do, these guys have been doing for years. So it'll be interesting to see how Coach does versus what Coors has done over the years. But they sell bags, shoes, watches, accessories, as it says across the top there, and a whole bunch of stuff that competes with companies like Coach. Here's a look at the Value Line report, and one of the reasons this one comes before us is kind of a triple play type thinking. In the upper left there, you can see that the low total return forecast has finally made it back up to 13% as the price has dropped from $100 basically down to about 60. So we've seen about a 40% price drop over a period of about a year and a half, and that's related to global recession, some increased competition, all that kind of stuff. A company that's maturing a little bit, but we're basically looking at a company with a double-digit return forecast, a price that has relaxed and sagged back after an initial kind of almost a launch escape velocity time frame there from 2012 to mid 2014. But we're now dealing with a company that has a low double-digit PE ratio. And one of the things we like to look for with companies that, I know that retail and apparel drive some of us crazy, so this is not a company that I would fall in love with, but could find a pretty good run because the company has had a very stagnant, stuck in the mud type stock price for some period of time. During a period, as we'll see when we look at the business model analysis, during a period when sales and earnings have actually been doing quite well and continuing to push forward, albeit slowing from those early launch type periods. The company that he was just describing is back closer to that 2012-2013 timeframe, hopefully for the drug company that he was describing. But as you can see here, the earnings have actually looked pretty good. The projections or expectations have tailed off a little bit, but nothing really traumatic. And even the sales, pretty steady, a little bit of flattening, but again, nothing terribly traumatic. But we'll watch them closely. The other thing I like about the company is they don't have any debt. So this is a company with no debt, and that can sometimes provide some shelter. Here's a look at the visual analysis for the company. Again, quite a launch period. The earnings the stock price is following the earnings a little bit there, and if it does continue to follow the earnings, if we meet these projections, we are looking at a pretty good situation. The value line numbers are there in the left-hand column on the summary. Again, the value line is looking for a growth rate somewhere around 10%. Keep in mind this is a company that used to be, 15, 16, 18%, so that 10, unless you keep it in perspective, is quite shocking. It's very devastating to much of Wall Street. But to all of us here, we know that a 10, 11, 12% growth company that's well managed can actually be quite a good thing to find. The projected net margin in that 17 to 18% range, and again a PE which has been a little bit higher historically, but is now drifting down into the maturity zone in the high teens. My assumptions would be a little bit more growth, perhaps a tiny bit more profit margin, but again, the numbers are virtually identical between the numbers that I would use and the value line analyst. In any event, we're talking about a company in that 13 to 15% return forecast range. It's still got some downside to it, but it's a company I could finally warm up to because we've waited for this for quite some time to get back into. Here's one of the other things that kind of brings it home for me. What you're looking at here is a slide capture straight from the forum at Manifest, taking the 2,400 companies at Manifest and sorting the companies with a quality rank greater than 90 only. So you're talking about the top 200 companies at Manifest. We put this out on a weekly basis for the update companies, the companies that are just being updated that week. But in this case, we took a look at all 2,400 companies. And just some characteristics there. We're looking for companies that have the highest return forecast in combination with their quality rating. That would be Cognizant, size selection for tonight. You see some other companies that have been favorites here, Priceline and Celgene. We've also talked a little bit about Green Mountain. But what you see here that kind of compels me a little bit to overcome my aversion to apparel and retail companies is this company does seem to be pretty well positioned after a drop, at least in the perspective of the rhinos on Wall Street. And what you're looking at here is the analyst consensus from all the analysts that cover the company. It has the best one-year outlook amongst all of these very high-quality companies, including S&P, as shown there by that second point. So, basically across the mix, a 13 to 15% return, excellent quality rating. Even Value Line agrees, and Value Line's been pretty pessimistic here lately. A low double-digit return on the low total return forecast, and then on the far right-hand side, you can see some very interesting outlooks. The overall analyst consensus, I believe that's about 36 analysts. Standard & Poor's checks in with very high expectations for the next year, and in the case of Goldman Sachs, they're off the charts. Now, some of those may come back a little bit. The other thing that's a little bit crazy that I should make you aware of, these guys report earnings at 8 o'clock tomorrow morning. There'll be an 8 o'clock conference call, and right now it's pretty optimistic about what could happen, but as you know, a company in a jittery industry like this, if they come out with any weakness or any cloudiness of expectations, could take quite a hit in stock price and continues south of that $60 level, but we'll take that risk, perhaps buy a little bit more or add it to the portfolio if it does happen to go down a little bit further in price. Again, the main feature is a company where the fundamentals have been fairly consistently improving and maturing, with a company where the stock price has been headed south. And again, a lot of that is early stage investors getting cold feet, demanding 18 to 20% growth rates when 10 to 12 is actually just fine. And with that, we'll go ahead and add cores to the portfolio. And that takes us to Cy and our 11-time selection of Cognizant. So he's going to make it 12 apparently.
Thanks,
I
Si.
was just saying that I had actually picked Cognizant in San Jose during the Take Stock panel that Hugh mentioned earlier. I said Cognizant, Gentex. And since Ken did that this evening, I had thought about Cognizant, and Ernie from Boston picked Cognizant as an audience pick and preempted me from doing it in San Jose. So I'll do it tonight. I also noticed, Mark, that you said our regular agenda, and you had Cy picking Cognizant, so I figured I had to follow through with it tonight. This will be the 12th pick on Cognizant, but before you tune me out too fast and say Cy saying the same old thing, I would like to mention two things. And one I'll expand on throughout the presentation, because I think we all basically know what Cognizant does. It's in the IT consulting industry. It's for companies outsourcing much of their IT, and Cognizant is a leader in that industry. One thing that Cognizant, although they're not alone in this regard, for a while in the last year or so they have been, but they are a stock that has had significant momentum behind it. In other words, it's been being pushed up by the market and doing well historically, while at the same time maintaining very solid projected returns going forward. It's kind of been a little bit different from what we normally say, that when price goes up, par goes down. When par goes up, it frequently is because the prices is coming down. Now, of course, we always qualify that with all things being equal, that being the case. And in Cognizant's case, all things aren't equal. The business continues to largely boom. So that's been a solid it has been a solid historical performer over the last year or so, and it still has great prospects looking forward, and that's what we'll look at closer. You can see here on the summary screen good, solid historical results, and Value Line has it with a 12.3% return using their assumptions, and the manifest defaults consensus is 16.4, which you'll see is also an excellent relative return to other prospects. Next slide. Here is where I picked Cognizant, other than just waking up and saying it's time to do Cognizant again. I haven't done it at all this year. The last time I picked it was December of 2014. So I did, first of all, just called up all of the companies that manifest. You get a very quick sweet spot screen comes up. It looks like this on your computer screen, and you notice Cognizant has the highest return when I did that, which was actually with closing prices yesterday. So it's changed a little bit today. You also see Michael Kors that Mark picked is number 3 on that. And I was going to say keep this screen in mind, but actually it's the next one. Next slide, Mark. All right. Then also, in addition to the manifest sweet spot screen, I went ahead and did a stock search as well, and you'll see many of the same companies overlapping here. My criteria are there on the right-hand side of the slide. I put in a par of 11% as my minimum. That's just a little below where the sweet spot was for the when I did this screen. Excellent quality, financial strength. I was playing around with it. I mentioned earlier I like 80 right now in today's market. I plugged in 79 on this screen because I was just trying to see if there was anybody right on the cusp. It didn't happen that there was in this particular case. I was looking for higher growth, so I used 11%. And here you see the companies. There's some overlap with the sweet spot screen you saw earlier. And 4 companies caught my eye. Cognizant, Maximus, another software consulting company, Priceline, and MasterCard. And I was really leaning toward one of these other three companies, just so that you didn't accuse me of always playing the same, singing the same song for one reason. But the reason that I stuck with Cognizant are shown on the next few slides. Next slide, Mark. Here is Cognizant. This is at the bottom of the stock study screen, or the Eagle screen at Manifest, and the Eagle screen I'm referring to is not the My Stock Study screen. I'm talking about the default consensus screen that Manifest does for all stocks that it covers. And at the bottom there is the Chronicle, which gives you the historical look at the stock price, which is the green bars. It shows the actual par at the time of the graph, which is the red or the pink line. And then there is the projected relative return, which is the difference between that par line and the my par on the particular date in question. And that is the solid graph, pink colored graph, area graph. I was trying to think of the name of that. I believe that's called an area graph that Mark is circling there. And you notice that the green price bars show that Cognizant is nearing an all-time high. It has pulled back just slightly, which could indicate a little bit of a buying opportunity perhaps. But notice also that both the par and the relative, the projected relative return are somewhat low. So, you know, it gives me a little bit of pause for concern. However, again, remember, we're at the market as a whole is all-time highs. Next slide. Here are the other three companies I said that I was considering: Maximus, Priceline, and MasterCard, and I've left the Cognizant Chronicle as well. Notice something very interesting about these three slides, or these four companies, this slide. All four Chronicles are in very similar state. Again, not surprising given that the market is high, but all four of the companies I was interested in tend to be running at highs, 52-week or all-time highs. They all tend to be running in the middle to low end of par and the relative projected return category. So what that tells me is either I'm going to do what Hugh occasionally does and says, nothing catches my eye in this market, and I'm going to sit out this month. That's one choice you have, and that can be a perfectly legitimate choice. Or to me, the second one is you take the stock with the highest total return, which in this case is Cognizant, and as you saw, it's one of the highest in both the sweet spot and on my very high quality, high return screen that I had. So, you know, to me, this month I had two choices: go with Cognizant or go with no one, because really these my concerns about Cognizant being maybe a little on the high side and ready for a pullback are I see the same conditions with the other companies that I was interested in. So here is my judgments on Cognizant. And I chose, just again, since it's being a little pricey, since Cognizant did in the last quarter of 2004, the quarter ended December, had a little bit of a pullback in sales due to some weakness in Europe. Remember, Europe is in a recession. We're slow growth environment in the United States, but Europe, where Cognizant has significant significant business, is actually in a recession. And it has pulled back a little, although that tended to reverse itself a little bit in the second quarter. But I use relatively conservative judgments in this particular Eagle just because the market itself is somewhat wary of Cognizant and has been for a long time, despite the fact that it has done very well, which is why it does keep a very solid projected return, although it has also done very well. And notice the three judgments that I made: 17% growth. I left the net margin the same at 14.2. And the PE ratio of 23, which is just a little below the consensus of 24, and that gave me a solid projected return of 12.5%, which is again, is within the sweet spot of 5 to 10 points above par, although not quite as optimistic as the consensus analysts. So for all of those reasons, I'm suggesting we do a 12-bagger, and I recommend to the audience we do a 13-bagger, or pick anyway, on Cognizant.
Well, thanks, Si. Ken, do we have a poll for tonight?
Of course we do, Mark. Let me get it pulled up and put it onto the screen. Just take your mouse, folks, and mouse over the stock you'd like to choose. We'd like to have about 80% of you in attendance voting if you can, so it doesn't hurt anything. It's all free. Just make yourself a vote.
None of the above works too.
I'm going to go about 5 more seconds. We're at 85% voting, 86%. And I'm going to close the poll. And I'm going to share the results. And it looks like we're going to add 2 holdings in Gentex and 1 in Ardelyx, 1 in Michael Kors, and another 1 in Cognizant. We have a number of questions, Mark, and do you want to handle them now, or do you want to close the official and then take the questions? Mark, how do you want to run this?
Let's go ahead and leave it running. We're at
okay.
9:40, so.
Okay, we have a question from Susan, and she says, can the roundtable rebuy if and when Staples and or Deere come back to life? And I'll answer that one, Susan. We can always buy Staples, we can always buy Deere, we can buy any stock we wish. Even if we've closed out a position entirely, we can go back and buy it again and make it an active position. Both positions will be part of the final analysis and the final numbers, but there's nothing to stop us from going back to something we've decided to close out. Mark, you want to add anything to that?
Ditto.
Okay. Joe wants to know, what future impact to Gentex do I see from HomeLink? Joe, it all depends on how big this Internet of Things becomes. HomeLink has the potential to allow you to control from your car almost anything on your home or grounds that's connected to the system. Right now, it controls garage doors and lights and things like that, but it has the potential to control thermostats and major appliances. It also has the potential to open things up all over the place. So you don't only have to open a garage door. Think of farmers opening gates for livestock, or think of some of our plutocrats opening gates to get into their 3-mile drives to their mansions. So HomeLink has the potential to be something really big, or it has the potential to be eclipsed by other technology. I think only time's going to tell, but obviously Gentex feels that this is something that has some potential to it. Lorraine wants to know, can we use these new Gentex mirrors in old cars? My understanding, Lorraine, is that most of these mirrors are original equipment to new cars, and that it's very difficult to retrofit them onto an older car. That might change as the technology progresses, but right now I think that it's almost impossible to retrofit these mirrors onto older cars. Carol has a question for Hugh. She'd like to know, is getting one drug approved an indicator of potential future success?
It's a good question, and I would say it's not necessarily the case. Because very often when a company gets a drug approved, one of two things will happen. The company gets acquired, or more likely, the people that brought the drug to market put something in the resume which very few people in the industry get to do, and that is that we brought a drug to market. So they themselves become quite marketable, and they get acquired, they get hired into other companies, very often with the idea that these people have the secret sauce and the magic, which is never the case, because it's really a combined effort and an emergent property getting a drug to market. So, yeah, I don't think it necessarily signals for the future. Now, there are stellar examples to counter that, but they're very few. Amgen was a startup at one point, as was Gentex, and we brought multiple drugs to market. And currently, Gilead is doing something that very few companies have done, and that is it has, over its lifetime, brought multiple drugs to market. But this is a compounding effect, and the question is, if the people that are able to bring drugs to market stay with the company, and very often they just don't, they move on.
Thanks, Hugh. Mark, Lorraine would like to know, what does EAGLE stand for in the manifest system?
EAGLE is simply an acronym for Equity Analysis Guide, and then we sometimes tack on long-term expectations. So it's Equity Analysis Guide for Long-Term Expectations.
And Mark, Jane would like to know, are you comfortable with the only 3 years of publicly traded data that exists for Michael Kors? Do you think that's enough data to make a good judgment from?
It's a great question. There's actually 3 or 4 years of operating history as the company has matured and kind of ramped up. Keep in mind that we always embed a couple more years of forward-looking expectations. So we are dealing with a little bit longer time frame. Anytime you're dealing with less than 10, even less than 5, you do want to be careful. You're dealing with a little bit less information, and often you'll be dealing with a company that has not been through a serious correction or recessionary test. So that has to be factored into the thinking. Michael Kors was kind of around towards the tail end of the last recession, but again, any analysis of a company like that would probably or should probably include an awareness of it's probably going to behave like a company like Coach the next time that we do have that type of economic moment. That's what you're missing with the company.
Thanks, Mark. Marie just has a comment. She says that HomeLink has the potential to be hacked and she'd pass on it. And Marie, I would just make the comment that anything connected to the internet has the potential to be hacked. I think that we're living in a brand new world where we're not nearly as secure as we used to be, or at least we think we're not nearly as secure as we used to be. Mary says that her local specialty dealer told her that they could put a mirror with a rear camera in her older model car. And Mary, I don't doubt that a complete system could be installed in an older car, but I don't think that just the mirror itself can be retrofitted. I may be wrong, and I would suggest that if you're really interested, you make a call directly to Gentex in Zeeland, Michigan, or you talk to a dealer that carries vehicles that are equipped with Gentex mirrors. We have a question for Anne, and she wants to know what auto companies are now using Gentex. Anne, when I first presented Gentex last year at convention, I had a list of the auto companies that use Gentex, and surprisingly, it was about 30 of them from throughout the world, and they were being used on over 100 different models of cars. One of the things that Gentex was trying to dispel was they called it general knowledge, even even though the facts were all wrong. It was the general knowledge that Gentex mirrors only appeared on a few American cars. Absolutely not true, and you can go to the Gentex website and you can get a lot of information about which cars use which systems, and you'll be pleasantly surprised to see that they're from all the continents that make automobiles, and like I said, 30 or 35 different dealers that deal with Gentex as a supplier. Mark, that clears up the question box. Usually when I say that, 3 or 4 more questions appear. I don't see any questions. I also don't see any hands raised in the air.
We'll be out with information on the June session. Do you have a date for the June roundtable, Ken?
You asked for the date, Mark? Is that what you asked for?
Yes.
The date for the June roundtable is June 25th, for those that would like to know. And the July roundtable is on July 28th. We're bouncing around a little bit, trying to accommodate folks' vacation schedules. We have a great comment here from Jane Johnson, and I'll give Jane's last name. She's a director in Western Michigan, and she lives right near Zeeland, and she attended the Gentex annual meeting, and she was informed that these mirrors are not just going into luxury models anymore. They're going into a wide range of small and mid-sized cars as well. So they're greatly expanding the models, and also, like I said, they work with auto dealers throughout the world, not just the big 2 or the big 3 automakers that are basically here in the United States.
Yeah, I can second that. We've got the mirror and home link in our family van.
I have the mirror and home link in both of the vehicles that I own as well.
Yeah, but you drive a Bentley.
Yeah, okay.
I was going to say, you drive a high-end car too, Mark. Not like us poor guys.
Hugh, Carol would like to know, have you come to any conclusions in your quest to determine successful BI type stocks at early stages? Have you come up with a set of rules yet, Hugh?
So for biotech companies, it is a good question. A couple of things that I look for, and that is who invested in the very early rounds. These companies are funded usually by venture capitalists, and they have a number of rounds, A, B, C, D, etc. And I look to see who invested in there, and I have a list of VCs, the more high-tier ones that I look at. The other thing I look for in a CEO and the senior management is, and this mirrors what I was asked for earlier, is have they brought a drug to market before? And that tends to be quite critical because it is a complex process, and a lot of things that you might take for granted get you into trouble. So have they past experience bringing a drug to market? I generally like to see if it is a first-in-class. So if this is a brand new way of addressing an illness. Now the sad thing is that very often, and I would say maybe 4 out of 5 times, maybe as many of that, the company that develops a brand new way of solving a problem and brings a drug to market ends up not dominating the market. If somebody else comes along that goes after the same, it's called a mechanism of action. So it goes after the same mechanism of action and it ends up with a better drug. But fine, the company that actually exploits that mechanism of action initially can do quite well. And, you know, have they had an exit, a successful exit before, which I'd like to see. In other words, have they developed a company and either brought it to the point of an IPO or sold it to another larger company? And by the way, time and time again, in my professional life, I will go into these small companies, and when they get acquired, it's sad. It's almost like somebody adds cholesterol and healthy doses of cholesterol into the process. So this once nimble and efficient company that discovered nice molecular targets, that discovered nice drugs to address those targets, that ran extremely efficient clinical trials, and that moved from A to B in the drug approval process very nimbly, these companies suddenly grind to a halt when they're acquired by the behemoths of the world, the old giants, as they put more structure to help the company become more efficient. And they actually sometimes drag people out of the company. Please teach us how to do it. And they're basically saying, but we're trying to do it, and you're making us run these seminars all around the world with your employees, and we're not been successful anymore, but the big companies don't care. So, yeah, when it gets acquired by the big company, I know it's off topic, that's when you see everything get destroyed, and that's often more illustrative of what the secret sauce is.
Wow.
Thank you so much, Hugh. Mark, again, I have the question box cleared, and I don't see any hands in the air, so it looks like the main session of the roundtable has come to a finish. I want to thank Cy and Hugh, and thank you very much for helping us out. And I want to thank our wonderful people for continuing to attend this session. We had a really nice group here tonight, and now we're getting a lot of good nights and a lot of thank yous in the question box. So it's time to close everything down, I think.
Thanks, everybody. Sorry for the technical difficulties.